again. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It's Wednesday, hump day. That's getting through it already. So, again, just kind of getting through the week here. Danny Ratliff joining me today, of course, talk a little bit about changes to tax laws that are coming up now. Unfortunately, this is February, which means that April 15th is right around the corner. So, it just never gets better, but it's just all part of it. So we're going to go through some of the tax changes, of course, as tax filing season comes up. What about those child tax credits? What about some of the extended unemployment benefits, things that you need to be aware of as you start getting ready to prepare for tax season. It's always the big thing. The other thing is also, we'll get into a bit this morning, talking about tracking errors. So there's kind of a few things that we're getting a lot of questions on here lately, and not surprisingly, with the markets down, previously, and now the markets are rebounding strongly. A lot of questions about, what happens next and what does this mean? And we're going to kind of get into all of that today. NASDAQ's up about 7.4% over the last 3 days. Big rebound rally here. Of course, that's what we've been talking about this morning. NASDAQ's going to be up about 1% at the open, and that's really on the back of Google's news yesterday. So Google reported earnings yesterday, really just beat across all metrics. And again, this has been common with the big tech stocks here lately, Apple, Microsoft, Google now. Just really kind of beating across all the estimates, really across the board. Big news for Google, though, is they are announcing a 20-for-1 stock split. Now, this is interesting because over the last few years, really, it's been mostly about corporations buying back shares. In other words, reducing their share count, which helps boost earnings, right? So if I earn $1 a year, simple math, right? My company earns $1 a year in earnings, and I have 2 shares outstanding, then my earnings per share are 50 cents, right? So if I buy back 1 share, now all of a sudden my earnings per share are $1, right? So I look better. Even though I didn't increase my sales, I'm still only earning $1. My earnings per share went up dramatically because I bought back 1 of the shares. So that's real basic math, but you get the idea. I get the illusion that even though I'm not growing sales, my earnings are getting better simply by buying back the number of stocks that are the number of shares outstanding. Google's doing just the opposite of this, right? So they just kind of killed it across the metrics, right, in terms of earnings growth, and this is all based on per share metrics. Now they're going to increase those number of shares by 20-fold, because when I do the stock split, I'm going to increase my number of shares by that amount. So again, big jump in shares outstanding when they do the stock split. The good news is, of course, that this will reduce the value of Google from roughly $2,500 a share, $2,700 a share, to basically about 14, right? So you're going to have this big reduction in the price of shares. So you take, if you want to figure it out, take 27.52 divided by 20, and that would be the new share price. Now this is going to happen in July, right? So this is going to lower that value. This is going to give people, the theory is that more people will have access to buy the stock. If I have a small trading account right now, I can't afford to buy a $2,700 stock, but I can buy a $140 stock. So it makes a whole lot of difference in terms of getting more retail investors into the markets when you get lower share count. So again, but this is an unusual thing, right? Stock splits are something to become a rarity really over the last couple of decades, as it's been more of a search for creating earnings per share growth. We've been relying on stock buybacks to help support asset prices, but and again, back in the late 90s, stock splits used to be a regular thing. I used to get every time Exxon Mobil got to $80 a share, they would split their stock. And if it got to 80 and it didn't split, everybody would be calling me up going, they're at 80, are they going to split? I was like, it's up to them. But, but this has become a real rarity as we become more dependent on stock buybacks to help support earnings per share. Stock splits have become a bit of a rarity. So again, not completely rare. Tesla did it also. Did a 5-for-1 stock split, but Google will be up today about 10%. So it's going to be a fairly large jump. It's going to put Google back around the 50-day moving average this morning. And again, kind of coming off that very oversold level, breaking out of this recent downtrend they've been in as well. So that's all very good news, very bullish for Google shareholders this morning. We have about a 5% weight in our equity portfolio. AMD also out this morning reporting earnings. Those earnings were better than expected. That stock also going to be up 11%. That's also going to probably bode well for other chip makers in that sector, like NVIDIA. Those will probably also be up today as well. Again, NVIDIA, AMD, those are kind of the chip stocks. We own both those shares. Full disclosure in our equity model. Because those are going to be focused more on kind of next gen technology, the metaverse, all this. That's graphics, gaming. Those are the companies that are Bitcoin mining with NVIDIA. So those earnings will probably continue to do well as we move forward in this environment. Now, again, if you'll notice, the ones that are doing well here in terms of earnings have been technology. Now, Exxon Mobil also had very good earnings out yesterday. Stock was up about 5% during the day yesterday. Really good earnings growth in terms of an oil and gas maker. Now, this is, of course, the whole ESG thing. One thing, I've got an article coming out, and I wrote about this recently for the Epic Times, which is that if you take a look historically, while we get into this whole idea that we want to be ESG investors, right? Environmentally, socially, governance conscious, right? We want to be new climate referendums for the entire market. This is the new thing. Lots of funds being thrown up now that all have the ESG title. Doesn't mean they actually invest in ESG stocks. But as we've noted before, back in the 90s, we were doing this with sin stocks. And once sin stocks began to outperform everybody else on the planet in terms of the stock market, everybody ditched this idea of not investing in sin stocks, started investing in sin stocks again. I would suggest that with Exxon Mobil breaking out to new highs here, and again, if you kind of look at ESG versus energy, right? Energy's the dirty energy. We don't want to own them anymore. They're terrible. It doesn't take this much performance before other people start jumping back into the oil and gas trade. And this has been a very, very good trade here for a while. We're long Exxon Mobil and Marathon in our portfolios. Now, importantly, after they announced earnings yesterday, stock did well. 3 standard deviations above the moving average, very overbought. We took profits last couple of days, and really it's just those positions very extended here. Probably going to get a pullback. And as I was saying a second ago, if you take a look at what's happening with Google, Apple, Microsoft, etc., those stocks are doing well. Their earnings growth is very strong. And if we move into a disinflationary environment, which is very likely later this year, those technology stocks are going to continue to outperform the reflationary stocks because of that ability to generate growth in a slowing economic environment. Now, one thing in particular that we talked about previously is watch profit margins for these companies, because one thing that is becoming evident through this earnings season is that profit margins are contracting. And that's because of inflation, higher labor costs, those type of things that can't get passed through. That's beginning to shrink profit margins for these companies. So in other words, the best of the best is likely behind us now. That $5 trillion in liquidity that generated all that economic activity that all flowed through right into earnings. People were out buying stuff, buying Apple products, buying Microsoft products, whatever it was, gaming, etc. That all flowed through right to those bottom line earnings. That's why these reports are so good. This is the end of the fourth quarter of last year, which was the tail end of all that liquidity and economic recovery. Inflation now is becoming a problem, less liquidity, profit margins now shrinking, which is going to make it a bit more challenging for earnings as we go forward. So we may be seeing the best of the best in terms of earnings for the time being, but we'll get back to this and more with Danny Ratliff right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And what? Not yet. Are we there? Are we on? Okay. What's happening over here? I can't hear myself this morning. There we go. A little better. Good morning, Danny Ratliff. How are you, sir?
Doing great. Good morning.
So a few things to get into this morning. We had Candid Coffee this past weekend. It's on our website now. So if you go to our website, realinvestmentadvice.com, right on the front page is our featured video, which was our discussion. I joined Danny and Richard this weekend for the Candid Coffee. We just kind of went through inflation, the market sell-off, positioning, kind of what our thoughts were going forward, why disinflation is probably a bigger challenge. So if you, it's on there on site, and you can kind of listen into the conversation and the different things that we talked about. And we got so many questions that we couldn't get through all of them. And again, during these Candid Coffees, you get to ask questions and we answer them. That's the whole point about it being a Candid Coffee, is that we're kind of just answering your questions. And of course, with everything that's been going on in the markets, had lots of questions. So we're going to get into some of those questions in the next segment. But two topics for this segment I want to get into with Danny because, as I said earlier, tax filing season is fast approaching, right? April the 15th, right around the corner. And there's going to be a few little sticker shocks for individuals that is going to happen this year that is unlike we've seen before from a couple of different perspectives. Because of all the stimulus that was thrown into the system, it's now as they always say, nothing is ever free. And while you got free money because you didn't work for it, it's not necessarily free from a tax perspective, and now is going to become the time that the bill comes due, so to speak. So, Danny, let's talk about child tax credits and some of the sticker shock people may be seeing coming up pretty quick.
This could be huge sticker shock. We talked about the economic impact that this had, but now we're going to see the back end, the repercussions of it, potentially having to pay back a lot of these funds that people received. So keep in mind, big changes happened with child tax credit. Number one, they moved it from $2,000 a year to $3,000, also increased it up to children up to 17 years of age. But another kicker, if you had children under 6, they'd provide you with an additional $600. So essentially $3,600 for families with children under 6 years old, $3,000 if they were over. So the big kicker here is the change was they made this instead of just a credit on your tax bill to a refundable credit, and they started paying half of that on a monthly basis. So a lot of people just started seeing in their bank account money and like, wow, this is great from the Treasury. Fantastic. Well, it could be good news, but it's also could be bad news because they also lowered the income limitation. So if you're single, it's $75,000. If you're a family, it's $150,000. They brought those numbers down from $200,000 and $100,000. So now people who historically would have received these, they may be actually under that threshold. You also can be phased out, meaning that you won't get that full amount. So what this means, everybody should have just actually received here recently a letter 6419 from the IRS. And what this letter states is how much money you received throughout the year. So remember, half of that was being paid out throughout the year, which was a big economic boom. So now you may actually have to pay some of this back. Now, you had the ability to go in and cut this off. The IRS did have a portal, so you could utilize something like that. Many did. A lot of people just said, you know what, I'll figure it out at the end of the year. I want to get as much money from them as possible. Understand that as well. Just understand they're going to want that money back if you don't fall within those windows. So what we fear is that they've made this so convoluted that you're going to need to hire a CPA, and it's probably going to cost you more than what you'd actually get from this by the time you're all said and done. So wait a second now. Lance, you talk about you remember how Kevin Brady wanted to do a postcard? Man, we miss those talks in those days right now. So some of the forms that you could have to have are Form 8812, 3911, 2555, 8379, 8332, 14039. Now, I'm sure everybody's very familiar with all these forms, as most CPAs are, I'm sure. Yeah. But
sounds like Tom Brady calling a play.
Not anymore.
That's right. But so you get my point. This can be very overwhelming for many people. It's unfortunate that we've taken a good thing and now we've made it even that much more difficult.
Well, I'm going to blame Facebook for this as well.
Okay.
Because used to be in the day, you would actually enjoy a trip potentially to the mailbox because there would be a letter from a friend or a letter from a loved one, birthday card, whatever. And now because of social media and all this stuff, there's nothing good in the mailbox anymore. It's just bad news. I check my mailbox and I don't even check it. I send my wife down to do it. But about once every 3 weeks. And because there's nothing but junk mail and bad news in it. I mean, it's now you're going to get a letter. Guess what? Go check your mailbox. You got a letter from the IRS. That always brightens up your day.
Hey, what's this, honey? Put it in the shred pile.
Exactly.
I kid. But you will be getting something in the mail if you have not already, if you have a family. So I would be ready to open. Make sure you put that with your tax documents. Hopefully it's a lot easier than what, the current state of affairs looks like it's going to be right now. But beware. You could have to come back and pay some funds. So, one of the bigger things is that we talk about all the, the impact and, people unable to make, ends meet at the end of each month sometimes and, not being able to meet emergencies. And now you potentially have somebody coming out of pocket with a lot of money.
Yeah.
Because we saw this money was spent. I mean, it helped the economy quite a bit. That's why a big problem with inflation. In fact, some of the stats were that it brought 50% of the families below the poverty line above it.
For about 27 seconds.
And you and I talked about this, that was going to be great for the moment, but then next year it reset, and now where are they at? They're back below the poverty line.
Yeah. Well, that's the wonderful thing about, this. And again, the idea of increasing child tax credit is fine, right? If they would have just left it a credit, so when you just filed your tax at the end of the year, it's you either get it or you don't, right? Mm-hmm. I mean, you're phased out, but you're not having to come out of pocket for it. And most people, as you were saying, since most people don't have any excess savings, and there was a great chart out just yesterday that we put out on Twitter showing that, when we talk about that $2.7 trillion in savings, it's all owned by the top 10% of income earners. Yep. Nobody else below the 90% has any savings of consequence. And, when you really get down into the bottom 50%, there's no savings at all. So, if all of a sudden there's a tax bill that you weren't depending on, where are you going to come up with the money from? Right.
That's right.
This is, and again, and if you have to pay an accountant or, heaven forbid, you file your taxes and misfile it, and now you've got now you really get that letter from the IRS that says, excuse me, not only do you owe us money, you now owe us money plus penalties.
And that's never fun.
Yeah. And that is just not a good way to start your day. So, anyway, just pay attention to it. It is a big issue. again, my wife was getting, child tax credits, in the mail, and I'm like, honey, just stick those into an account because you're going to owe all that back at the end of the year. So,
well, and that's a smart thing to do. And unfortunately, just most families needed the money or spent the money. And
but again, and again, and let's go back to the inflation side of this. This is always the problem with government, which is, we need to do this. We need to help people. Nobody ever thinks through the process of, I give you $3,600 to go do child care. Okay, great.
Now child care goes up.
Yeah. Do you not think that all the child care providers are going, hey, Danny's got more money to spend, prices are going up? And this is the thing that they can never figure out with college tuitions. Like, bad colleges. You're giving out free money for college. What'd you expect colleges to do with tuition, right? I mean, are you, but we didn't have this problem when the student loan were run by the banks, and you couldn't get student loans that easily because you had to qualify for them. You didn't have that problem with tuition cost. Get out of business, right?
Well,
your job is not to be involved in business.
And I think they thought this was going to go on in perpetuity. So the issue here now is that it stopped in December.
Right.
So now you have that inflation that it created, and those guys aren't backing off. So now everybody has less money. Their free cash flows diminished. I mean,
Well, and look, even if they had gone, and even if they had passed it into perpetuity, it still would have been everybody above the poverty line, but right back in it this year again, just because of the reset. Because unless you were increasing it every year, inflation's just going to put you right back to where you go. So
correct.
It's just, this is the problem with people we have running government. They have no sense of economics, even just basic economics.
And that's even worse because you created the inflation that's not going away. Then you took it all away. Sorry, guys. That was fun for a bit. Enjoy.
Well, and speaking of that, Joe, as we discussed yesterday, there was a lot of hope here that the Build Back Better plan would get passed in some form, which would potentially extend some of these child tax credits, provide some other money. And as I said yesterday on the show, early yesterday morning, I said there's really no incentive now for Joe Manchin and Kristen Sinema to go along with the Democrats on passing the Build Back Better plan, because when they opposed it, they raised a lot of campaign money. And yesterday, Joe Manchin said, "Now, Build Back Better's dead."
Well, and one of his big things with this was actually the child tax credit, that he wanted families to actually be working to
receive it.
Big deal. So, which obviously is probably not going to fly.
Well, it's not going to fly, but his thought process is right. And again, if we go back to, everybody wants to go back to talk about the 1960s and 70s. Why did you have 8% rates of economic growth? Because people were out, they were producing. You don't get economic growth unless you're working. And the whole backwards process that we have going on in government right now is we're trying to incent people not to work. If you tied your government incentives to work where people are producing, they produce, they generate a paycheck, then they can go consume. That's what creates economic growth. You need that virtuous cycle. So yes, tie all your government support programs to working. If both parents are working, they need child care support, great. Help them out. No problem with that. But just raising minimum wages and providing free money doesn't help the production side of the equation. It's what creates economic growth over time. So, and economic prosperity and wealth equality, by the way.
And that's part of the problem with Build Back Better plan, with many of these other plans that they have, is that it has no true productivity to it other than just a quick hit to it, and that's it.
That's right. All right, we'll come back from the break. Questions from the horizon. From Candid Coffee. We'll get into those. We got a lot of them to get through, so we'll kind of do a rapid fire session of Q&As from the recent Candid Coffee. Stick around. More of the Real Investment Show coming right up.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the Insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
They surveyed Americans asking how many guns do you own? 29% of the country owns 5 or more guns. So I tweeted this out. I said, I'm obviously in the 29% camp. So I got a tweet back, obviously from a non-gun owner, that says, I don't understand why you have to have so many guns. I've got coyotes behind my house. I've got copperheads.
The Real Investment Show podcast. Same show, your schedule.
And I'm not going to stand out there with a 9mm trying to shoot a copperhead.
At realinvestmentadvice.com.
It just ain't going to happen.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th. Register now at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me, of course, to talk a little bit about questions from Candid Coffee this weekend. We had so many questions for our Candid Coffee event on Saturday. Again, if you didn't miss it, if you did miss it, glad you were there.
Watch it again.
But if you did miss it, it's on the website now. Go to realinvestmentadvice.com. It's right on the homepage, featured video. Can't miss it. But we had so many questions, we couldn't get to them all. And honestly, we're not going to get to all of them today either. But we'll try to hit a few more of them for you. So why don't you just go ahead and jump on in, Danny?
Well, and keep in mind, we get so many different questions. Some of them are very, very similar. Then we have some that are so specific that they would only be really, probably good for one person.
Right.
And so we try to cover as much as we can. But so we thought we'd come back to it and kind of circle back on some of these questions. But one of the ones that I think we keep getting a lot of different feedback on is, one says, if we expect 2022 to be a turmoil year where the Fed continues to experiment with the market, weak corporate profits, inflated markets, isn't it better to stay in cash till the situation clears up and or a big correction? And we've talked a lot about
Right.
this, but I think this is one that we continue to receive lots and lots of questions on.
Right. So as we entered the year, so let's just look at where we are right now as a good example of this, right? So if you entered the year this year, in January, the first couple of days of January, market's doing great. We're following through with our Santa Claus rally. It's all fine. So, right, you want to be in the market. Then the market sells off, and all of a sudden, the risk of a correction is bigger. Now, we've been talking about having a 5 or a 10% correction now for over a year and a half. We said, hey, we're going to have a 5 to a 10% correction at some point. We're going to retest the 200-day moving average at some point. That's just a function of how markets work. Now, it doesn't mean anything. It doesn't change the bullish trend or anything else. And so we had this correction, but not surprisingly, as we've said often, is that a correction of magnitude, if you got down to the 200-day moving average, is going to feel a whole lot worse than it really is because it's been so long since you've had a 10% correction. We haven't had a 10% correction. I mean, look, headlines immediately from the mainstream media was, this is the worst correction since March of 2020, right? Panic, fear, malaise, the whole 9 yards. But all we did was retest the October lows. Right, and the 200-day moving average. Markets got extremely oversold. Investor sentiment got extremely bearish. But that was the point where everybody wanted to sell out. Right now, the market's rallied for 3 days. We're up. Nasdaq's up over 7.5% from the lows. S&P's up over 5%. We're within an earshot of all-time highs, and now all of a sudden, people want to come jumping back into the market. So the problem with going to cash, and here's my point about this. The problem with going to cash is the getting back in part. It's easy to get out, but if this market rallies to new highs here over the next month or so, and there's a real possibility with the yield curve flattening, ISM manufacturing out yesterday, sharp decline in ISM manufacturing, that's all very disinflationary, suggests that the Fed's going to back off rate hikes fairly quickly. This market runs some more, then you're going to want to get back in. And then you're going to be telling yourself, well, I don't want to get in now because now the market's overbought, so I'll just wait for the next correction, and now you're in the trap. So this is why it's important to not make these big macro decisions to be all in or all out, because it's very difficult to get reallocated. As we manage portfolios, we simply just reduce. I mean, right now we're about 54% exposure to the markets in terms of our target. Our target is 60% allocation to equities. We're about 54%. We reduce that equity. We've got some cash. So, as we kind of figure out where this market's going over the next couple of months, we'll eventually put that cash back to work on the fixed income side, on the equity side, wherever it needs to go. But, just managing risk is, as we've always talked about before, is a game of inches. It's small moves. It's not big macro moves, because the problem is once you're behind the curve, it's almost impossible to get back on the right side of it.
Okay. And you mentioned a couple of things there. So one, I want to put this in context. A 60-40 portfolio is generally what we use just as a reference guide. It does seem to fit a lot of clients. Our 60-40 model is much different than your traditional 60-40 that we will be underweight, overweight at different times. We'll also, we'll eliminate certain asset classes. So unlike many places where they say, hey, we're going to invest in every asset class just because that's what we should do, we believe that, hey, if we don't like an area, we'll remove it altogether. But another thing you mentioned was that trap. And I think that's really important, because you go back to 2008, we go back to many different times, and I visit with many people on the front line day in and day out. And a lot of times we'll have somebody who comes in and says, well, I've never made money in markets. And the reason being is because they try to do just that. They try to get all the way out, try to get all the way back in. And it's usually counterintuitive, right? We get out when things are bad. We think, oh my goodness, I can't take it anymore. We get back in because it's just going to keep on running, and I've got to be there. And we have that fear of missing out. And it's so counterintuitive to the old adage of buy low and sell high. We do the complete opposite. So that's why it's so important to do it in bite-sized chunks, understand what we do. So you mentioned something else, panic and fear. So lots of questions on, okay, if we do get into this environment where we do see this big recession, or we see a period where we do get into a bear market, what is the traditional areas of safety, is that still safe? And what I mean by that is, like, do people still flock to gold or other commodities? Or is Bitcoin the new gold? And I think we know the answer to this, but these are things that everybody's thinking because we're all being told by the media that this is how it's going to act.
Well, Bitcoin was down 50%, so I'm not sure that's where I wanted to flock to.
Yeah,
gold has been an underperformer now for quite some time, and supposed to respond to real rates, but it's a fear trade. And that was kind of one of the interesting things. I really expected gold to take off during this kind of correction in January, but it didn't. And, we had some relative fear in the markets, but, really when you take a look at what's happening underneath the surface, there wasn't a lot of panic. we had a lot of sell-offs, right? But there wasn't a lot of palpable panic of just investor liquidations, except for Monday, the Monday a week ago when you had that really sharp decline in the NASDAQ. That was kind of the first visible sign of just capitulation. But again, if you take a look at the overall surge and overall rise in the volatility index, it didn't spike up dramatically. It climbed higher as the market was selling off, which was what you'd expect, but it was never a sign of panic. So, these traditional alternative trades have not worked well. And it was interesting because in last weekend's newsletter, here's my last two sentences in last weekend's newsletter, because again, this is now the opposite of where we were. I said, we agree. The most challenging thing for an investor to do is to buy when everyone else is selling. However, that's precisely when the best trades ultimately get made. Undoubtedly, it's hard to buy when there's blood in the streets. And the whole point of the article was markets were deeply oversold. People were already, kind of panic selling the bottom. And that's typically the time you want to do the opposite of what your gut's telling you. So, this and again, when the mainstream media is all on one side of the trade, it's typically always better to take the other side. Right now, they're all inflation trades. So start looking at the disinflation trade, right? So that's, this is just kind of things to think about when you're managing your own money.
So to round off that question, if somebody does feel inclined to invest in silver, gold, another type of commodity, I know we've talked about, a lot of people like to hold this either. They'll have a company that holds it in a safe somewhere in the desert, or they may go buy coins. They may buy an ETF.
Sure.
I mean, there's so many different ways to purchase these things. What would be your recommendation? Because we see a lot of times that it's an all or nothing strategy where somebody says they go all in and they say, I'm going to put, half of my savings into this. We like it more in bite-sized chunks as well in that aspect. But, what would you not necessarily say recommend, but if from your viewpoint, how do you foresee the best way to invest in those types of investments?
It's not a best way, worst way thing. I mean, if you're buying gold, so let me back up. All I can do is tell you how I would do it. I can't tell you what's right for you,
because everybody's different. Everybody has
different,
different
right.
scenario. Yep.
But if I was going to buy physical gold, I would buy coins that are collectibles, that have a numismatic value to them. Because yes, they're gold, right? So they do have the benefit of the gold price, but there's also that premium that's paid to have a collectible item. It's like buying a piece of artwork or buying a rare exotic car, whatever it is. Used car prices are going up right now. So as an example, I can buy a used car, and if I hold it temporarily, the price keeps going up, and I could sell it maybe at a higher price. But that's not always going to be the case for used cars. However, a collectible, a very rare, car of some sort will hold value regardless of what the used car market's doing. So if I'm going to buy gold, I'm going to buy gold, a gold coin that has a numismatic value to it, that's a collectible. So buy rare gold coins, those type of things. If you're just trading gold, as an example, buy an ETF. And trade it. It's a commodity. So commodities go up and down in price. There's things that affect the commodity trade: inflation versus disinflation, inflation versus deflation, interest rates, those type of things. So if you're just trading the commodity, if you just want to own gold because you want to have a position to hedge against a potential runaway environment of economic collapse, just buy an ETF and trade that, because it's going to trade off the spot price of gold. But but if you want to own a bunch of gold bullion and have it sitting in a safe somewhere, more power to you. The only problem with that, and this is the issue that we always get into, and again, we just talked about this, and it works the same way with these type of assets, is that if you own a bunch of gold, it's great. The day you want to go sell it will probably be the day that everybody else is trying to panic sell their gold. So when you get down to your gold trader to sell it, there'll be a line wrapped around the building 3 times of people standing there wanting to sell their gold, and the price is going to be falling very quickly. It's always about supply and demand of the market. So, those are just things to consider. And again, what part of your portfolio is in gold is up to you. But if I've got a whole bunch of my money in something that's underperforming inflation, and I'm planning on holding it long term, and that's the key, right? I'm gonna hold this for years. I don't care what's gonna happen. I'm gonna own gold for a decade because it's gonna hedge me against inflation. That's been a real losing bet for a long time.
Hey, but not to mention, you just mentioned, where do you hold it? We just saw that the IRS went after somebody for holding it in a self-directed IRA, put it in their safe at home.
Yep.
And
can't do that.
They got dinged for it. Taxable event looked like a distribution. So you have to be very careful on where you hold these assets as well.
All right, we'll come back, wrap up with some more questions. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the Insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Rose Lance Roberts, of course. Danny Ratliff joining me as well. It's a Wednesday, so he's always here. Kind of like foot fungus.
But just on Wednesdays.
Just on Wednesdays. Kind of comes and goes.
Yeah, you never know.
I'm just teasing you.
Foot Fungus Wednesday.
It's a new tagline.
Yeah, man, tell me about it. Goodness gracious, I know what you think of me now.
Brought to you by Dr. Scholl's.
I get up for this?
We need to have Brett start, doing like, back in the early on the old radio programs, and the upcoming program brought to you by,
yeah.
Calgon. Wash. Man. What was it? What was their tagline? Calgon. Wash.
Take me away.
Yes, take me away. So anyway, let's wrap up with some more questions here from Candid Coffee. Of course, again, if you didn't hear, we're answering some questions from Candid Coffee this past weekend. The entire presentation is on our website. We went through a lot of stuff about markets, money, investing, disinflation, kind of our thought process heading out for the rest of this year. It's all on the website now. Go to realinvestmentadvice.com. It's right there under the featured video on the homepage. So, okay, let's continue on.
So let's tie up our last segment. We talked a little bit about what the market's doing, inflationary hedges potentially, traditional hedges like gold. What does that look like? How would you invest in that? But where has that gone? Right, gold is significantly underperformed.
Yep.
Some of the other things
it went all to commodities. Everybody was chasing the commodity trade, so oil and kind of hard commodities. That trade's likely over now. So oil prices are very high at this point, and they'll hang around here for a little while longer. but it's very likely as we move further into this year, and this is something we went to pretty good detail Saturday, and then Monday's article is hard assets, are they a trade in the making? Watch the dollar. The dollar is starting to rise here, and there's a lot of reasons for that, and that is an anti-hard asset commodity trade. So, there's a real possibility the commodity trade has peaked, and because economic growth is slowing down, we're going to start getting more. And again, go look at ISM yesterday. Go take a look at recent, manufacturing reports really across the board. That whole inflationary surge in the economy is likely peaked, and this is because the liquidity has peaked and it's beginning to roll off. Disposable personal, let me put it this way: if disposable personal incomes are unchanged this quarter, DPI will drop 34% on a year-over-year basis because the surge in the disposable incomes came in the first quarter of 2021, right? We had the whole $1,400 check from Joe Biden, et cetera, right? So that huge surge of disposable incomes is gone. And so you're going to have a very sharp drop in disposable personal incomes, which is going to translate directly into economic growth. And you're going to have slower rates of economic growth this year. In fact, Goldman out yesterday, we wrote an article in March of 21 called The Sugar Rush. And that was explaining why that surge in economic growth was going to reverse very quickly as we got into 2022. Goldman Sachs yesterday slashing economic growth. Atlanta Fed out on Monday talking about 0.1% GDP growth for the first quarter. So, yeah, be careful with the commodity inflation trade. It's likely over.
Yeah, and it's been moving so quick. I mean, it used to be, the talk was this is a 10-year cycle. And it still, it could be, but
you need 10 years. You need 10 years of liquidity for that, right?
Yeah.
So, and look, if you don't believe me, just go take a look at tips. I mean, they're telling you all you need to know right now.
Yeah, things have changed, and they're changing so quickly. So the year, in a lot of our reviews, we talk about what should we expect, and really it's being nimble. We want flexibility right now. I mean,
if you're watching, Brent, you can bring up, I put a chart of tip up on our screen. So if you're watching our live stream, you'll see a chart of the price of tip, which will tell you what's going on with inflation. Okay, next question.
Okay, so you're going to love this one because I know financial planning is your favorite.
I love
thing.
Financial planning. It's my favorite. Yes.
No, so
exciting.
So we did receive several questions on this saying, hey, look, I'm 3, 5, 7, 10 years away from retirement. How long can I put off doing a financial plan?
Never.
Well, you can put it off for as long as you want.
Yeah.
Now
you shouldn't.
You shouldn't. That's right. And so, what are your thoughts on that from somebody who doesn't necessarily? That's not your area of expertise, so to speak. Not to say you don't know a lot about it, but you like the investment side.
Right. Yeah. That's the side that makes me money. So, financial planning tells me what I can't spend.
Yeah.
Investing tells me what I can do, right? So that's why I like the investing side, because I can make money with that, and that's how I keep score. Financial planning only tells me what I can't do, and I don't like that.
Well, so hold on. No, man.
That's my personal thing. I'm teasing. No, look. What financial plans give you is they give you some parameters about how much risk you can take, and this is the most important thing. And this is when you're designing your portfolio. I have two choices. I can put all my money into Bitcoin, right? And maybe I'll win. Maybe I'll lose 50% of my money, right? And we have this attitude when we're young that it doesn't matter. What people forget is that if I lose $2,000 when I'm 20, that's effectively about $60,000 to $80,000 of value out of my retirement account when I retire because of the growth of that $2,000 over time. Right? So losing money, we have this very cavalier attitude about losing money. It's just a couple of $1,000. Let me ask you a question. If you had $2,000 in your wallet and lost your wallet, would you just go, it's $2,000? No. You'd be like, man, that was, down payment on a car or whatever it was, right? Yeah. We have this very cavalier attitude about our investment accounts because it doesn't seem to be real money. It's just play money, right? It's just some digits on a page and it goes up and down in value every day and it's all a game. It's like gambling in a casino. But if you start putting these things in perspective, and this is what a good financial plan will do for you, is saying, look, if you lose 10 grand, what does that mean for your retirement? If you lose 50 grand, what does that mean to your retirement? If you lose 100 grand, what does that mean for your retirement? Do you want to retire someday, or do you want to be like every schmuck else on the planet that's going to have to work until 90, right? Because the average American, 80% of Americans have less than 1 year's salary in the bank. They're never going to retire. And this is kind of one of the ironies of all this is like, we look at the labor force participation rate and we go, well, the labor force participation rate's low because all these people are retiring. No, they're not. They can't afford to retire. They're not retiring on 1 year salary. They may be retired. They're just working 4 part-time jobs.
Yeah, they're not showing up in your metrics the way they used to.
Exactly. They're at Home Depot, Lowe's, and Walmart, all working.
Yeah.
So,
and you made a really good point. And I think that's a big misconception that many people believe because the financial media tells us that, okay, when you're young, you can take all this additional risk, and it doesn't matter if you lose 50% of it. But it becomes much more important when you're close to retirement because then you really can't afford to. But now it's one of those things. If you look back and say, what could this money have made over time had I not had that big drawdown? That's where things change. That compounding actually comes into play.
Yeah, that's one other big fallacy on television is all the time is like, well, if you don't lose money until you sell. No, your portfolio value is what it is any day of the week. And if you're down 50%, you've lost 50% of your portfolio. That's it. That has nothing to do with the buy-sell transaction. Yeah. It is what it is.
So I want to take that a step further because you're looking at it from a portfolio management and a risk management side. So the way we view this as planners, we want to take this holistic view and take a look at all the financial beings and things that are going on within your financial realm. And we want to take a look and say, okay, where are the best places for you to put funds aside if you're saving so that it gives you more flexibility in retirement? I mean, we could sound like a broken record with this, but there are so many moving parts. So it's about saving money, keeping money in your pocket right now and later in life in retirement and having that flexibility to come out of it and say, hey, you can choose when you pay taxes, how you pay taxes, which the old school thought has always been, conventional wisdom has been, put everything in that pre-tax account. And you're going to have that tax-deferred growth, which is great. And then when you take it out, you'll be taxed at a much lower tax bracket. Unfortunately, we know that's just not the case.
Yeah.
So big part of it. So another one, we briefly broached life insurance during our conversation on Saturday.
Right.
And we had a lot of questions that follow up after that, and which we typically do when we have quick discussions around this. What's a big take on life insurance and permanent insurance? We talked about temporary, so term insurance, how that can work for risk management, but how you can use permanent for longer term solutions.
Right. Well, two things here, and we've only got a couple of minutes, so I'm going to make this really kind of quick. But like I said on our Candid Coffee event, I said if I was 20 all over again, I would have never bought term insurance. I would have bought whole life permanent policies right up front and overfunded them my whole life, and I wouldn't be working now. And there's a reason for that is because it creates tax-free compounded growth over time, and it truly compounds because it pays you a payment on the overfunding of your policy. Now, not every policy works this way.
You're referring to whole life.
Yeah, this is whole life mutual insurance, right? So not every policy works this way, so you've got to really know what you're looking at, and you need to know how to calculate what you're doing in terms of your overfunding amount, because if you miscalculate your overfunding amount, you can turn it into a modified endowment contract. Don't worry about all this stuff. And look, Danny can help you through all this. So just email him and say, please explain what Lance was talking about. But if you turn it to a modified endowment contract, everything that was tax-free is now taxable. But the beautiful things about whole life insurance is that you overfund them, they grow tax-free. You can then withdraw money from them tax-free. And I do this on a regular basis to make real estate investments or to do other things. I use it to leverage myself, borrow from myself to make other higher yielding investments. And then when that investment pays off, I repay the loan from the life insurance, and it's all a tax-free transaction to me. So, there's some huge benefits to creating long-term growth. And then when I die, then there's a death benefit that goes to my family, plus all the extra cash that's been built up in the overfunding status also goes to the family as well. So it creates a huge nest egg for your clients. And best thing is that they're judgment proof against lawsuits. They are kind of like an IRA in terms of that. They grow tax free. Withdrawals are tax free, and then they can be used properly. And if done properly, and it can be used as a ILIT, which is a life insurance structure to help pay your estate taxes in retirement as well. So, or at death. So it does just a whole lot of great benefit for you. But if you can only afford term to insure your family at a young age, that's what you need to do. I just wish I would have known differently when I was very young in life. I would have done different. So wraps up the show. If you've got questions about it, look, email Danny, and we'll get into it. And again, we may spend a whole segment on this on the show here soon just to really get into the nuts and bolts of it. In the meantime, get by the website, realinvestmentadvice.com. Click on the Candid Coffee link. It's on the homepage right now. It's our featured video. Get all the conversation and send your questions, comments, and emails. realinvestmentadvice.com. See you tomorrow.
It's a rich man's world.